For some people, investing in rental real estate is just too time-consuming and expensive. Having to find, finance, and then manage properties is definitely not for everyone. And even though there are ways you can limit your monetary and time investment, the fact of the matter is that it's just not for everyone. Well, what if I told you that there was a way of investing in real estate without having to search for the property, buy it, manage the tenants, and it has most of the benefits of owning cash flowing and appreciating real estate? Welcome to the world of REITs. Hello, my name is Max Monahan, I'm a real estate agent in Portland, and let's get right into everything you'd want to know about REITs. Before that though, please be sure to like the video if you're enjoying it so far, it does really mean a lot, and definitely be sure to subscribe as well if you enjoy personal finance and real estate related content. Anyway, let's get into it. What is a REIT? A REIT is a real estate investment trust that's a company that owns and in most cases operates income-producing real estate. REITs own many different types of commercial real estate ranging from office and apartment buildings to warehouses, hospitals, shopping centers, hotels, and commercial forests. It's like an index fund, but for a large portfolio of rental real estate. Basically, you can earn dividends from all real estate investments, all without having to buy, manage, or finance any of the properties. How do REITs work? Well, Congress established REITs in the 1960s as an amendment to the cigar excise tax extension. This provision allows investors to buy shares in commercial real estate portfolios, something that was previously available only to wealthy individuals and large financial intermediaries. In general, REITs specialize in a specific real estate sector. However, diversified and specialty REITs may hold different types of properties in their portfolios, such as a REIT that consists of both office and retail properties. Many REITs are publicly traded on major security exchanges, and investors can buy and sell them like stocks. These REITs typically trade under substantial volume and are considered very liquid investments. Now, what qualifies as a REIT? Most REITs have a straightforward business model. The REIT leases spaces and collects rents on the properties, then distributes that income as dividends to its shareholders. Mortgage REITs don't own real estate, but finance real estate instead. These REITs earn income from the interest on their own investments. To qualify as a REIT, a company must comply with a certain provision of the Internal Revenue Code, or the IRC. These requirements include to primarily own income-generating real estate for the long term and to distribute income to its shareholders. Specifically, a company must meet the following requirements to qualify as a REIT. It must invest at least 75% of its total assets in real estate, cash, or US Treasuries. It must derive at least 75% of gross income from rents, interest on mortgages that finance real property, or real estate sales. They must pay a minimum of 90% of taxable income in form of shareholder dividends each year. There must be an entity that's taxable as a corporation, be managed by a board of directors or trustees, have at least 100 shareholders after its first year of existence, and have no more than 50% of its shares held by 5 or fewer individuals. Today, it's estimated that REITs collectively own about $3 trillion in gross assets. Publicly traded equity REITs account for $2 trillion. Now, there are actually two main types of REITs. One is what's called an equity REIT. Most REITs are equity REITs, which own and manage income-producing real estate. Revenues are generated primarily through rents and not by reselling of the properties. And then there's mortgage REITs, which lend money to real estate owners and operators either directly through mortgages and loans, or indirectly through the acquisition of mortgage-backed securities. Their earnings are generated primarily by net interest margin, the spread between the interest they earn on mortgage loans and the cost of funding those loans. This model makes them potentially sensitive to interest rate increases. Now let's talk about how to actually invest in REITs. You can invest in publicly traded REITs as well as REIT mutual funds and REIT exchange traded funds, otherwise known as ETFs, by purchasing shares through a broker. You can buy shares of a non-traded REIT through a broker or financial advisor who participates in the non-traded REITs offering as well. REITs are also included in a growing number of defined benefit and defined contribution investment plans. An estimated 87 million US investors own REITs through their retirement savings and other investment funds, according to NARE, a Washington DC based REIT research firm. REIT activities resulted in the distribution of $69 billion in dividend income in 2019, and there are more than 225 publicly traded REITs in the US, which means that you'll have to do some homework to do before you decide which REIT to buy. Be sure to consider the REIT's management team and track record and find out how they're compensated. If it's performance-based compensation, odds are they'll be working hard to pick the right investments and to choose the best strategies. Of course, it's also a good idea to look at the numbers, such as anticipated growth in earnings per share and current dividend yields. A particularly helpful metric is the REIT's funds from operations, otherwise known as FFO, which is calculated by adding depreciation and amortization to earnings and then subtracting any gains on sales. Now let's talk about some pros and cons of investing in REITs. REITs can play an important part of an investment portfolio because they can offer a strong, stable annual dividend and potential for long-term capital appreciation. REIT total return performance for the last 20 years has outperformed the S&P 500 index and the rate of inflation. As with all investments, REITs have their advantages and disadvantages. On the plus side, REITs are easy to buy and sell, as most trade on public exchanges, a feature that mitigates some of the traditional drawbacks of real estate. Performance-wise, REIT offers attractive risk-adjusted returns and stable cash flow. As a real estate presence can be good for a portfolio because it provides diversification and dividend-based income, and the dividends are often higher than you can achieve with other investments. On the downside, REITs don't offer much in terms of capital appreciation. As a part of their structure, they must pay 90% of their income back to their investors, so only 10% of taxable income can be reinvested back into the REIT to buy new holdings. Other negatives are that the REIT dividends are taxed as regular income, and some REITs have high management and transaction fees. To briefly go over the pros and cons, the pros are liquidity, diversification, transparency, stable cash flow through dividends, and attractive risk-adjusted returns, and the cons are low growth, dividends are taxed as regular income, they're subject to market risk, and there's a potential for high management and transaction fees. And that's it. Thank you all so much for watching. I hope you enjoyed learning a bit about REITs. Please don't forget to like the video if you liked it. It does take quite a bit of time to make each one, and be sure to subscribe for 2 videos a week on both real estate and personal finance related content. Until next time, see ya.